Imagine waking up one morning and discovering something terrifying. Your money is still there. Your bank account still shows a balance. Your paycheck still arrives. But none of it works. Stores refuse cards. Banks limit withdrawals. Governments make emergency announcements filled with calm words and panic behind them. No explosions, no invasion, no obvious collapse. Just silence. This is what financial failure actually looks like. Because when the global financial system fails, it doesn't collapse like a building, it freezes. And once money stops moving, everything else follows. So what really happens when the global financial system fails? Not in theory, not in movies, but in reality, step by step. Setting the stage, the system we never see. Most people think the financial system is money. It isn't. Money is just the surface. The real system is credit, trust, settlement, timing. Your money works today because everyone agrees it will work tomorrow. Banks trust other banks. Companies trust payments will clear. Governments trust markets will buy their debt. This trust is invisible and dangerously fragile. When it breaks, the failure doesn't begin at the bottom. It begins at the top. Origins where failure actually starts. Financial collapse never starts with poor people, it starts with institutions. Large banks stop trusting each other. Overnight lending slows. Collateral becomes suspect. This is what happened in 2008. Banks didn't run out of money. They ran out of confidence. Once trust disappears, liquidity vanishes. And when liquidity vanishes, the system begins to choke. Phase 1. Credit freezes. Credit is the oxygen of the modern economy. When banks stop lending, businesses can't roll over debt, payrolls become uncertain, supply chains tighten. Even profitable companies fail, not because they're broke, but because cash arrives too late. This is why financial crises feel sudden. The economy doesn't decline gradually. It falls off a timing cliff. Phase 2. Banks turn inward. When stress rises, banks protect themselves. They tighten lending standards, freeze credit lines, hoard liquidity. This is rational behavior, and collectively disastrous. Because when every institution acts defensively, the system collapses faster. This is the paradox of financial safety. Phase 3. Governments step in. At this point, governments intervene. Central banks inject liquidity. Emergency facilities are opened. Interest rates are cut. Institutions like the Federal Reserve and the International Monetary Fund become lenders of last resort. This prevents immediate collapse. But it introduces a new risk. Phase 4. Currency confidence weakens. When money is created rapidly, people ask dangerous questions. Is this temporary? Is this inflationary? Will my savings hold value? If confidence weakens, capital flees, exchange rates swing, import prices surge. Currency instability turns a financial crisis into a social one, because inflation hits everyone. Phase 5. Markets disconnect from reality. In crisis, markets behave strangely. Asset prices may rise even as the economy collapses. Why? Because money floods financial assets faster than real production. Stocks detach from employment. Real estate detaches from income. Wealth inequality accelerates. This creates the illusion of recovery, until it breaks again. The breaking point. When payments fail, the true collapse comes when payments stop clearing. When ATMs limit withdrawals, international transfers stall, settlement systems delay, trade freezes, food doesn't move, fuel doesn't arrive, medicine becomes scarce. This is when financial failure becomes physical. Historical preview. This has happened before. History shows this pattern repeatedly. Weimar Germany saw currency collapse turn into social breakdown. The Great Depression showed how credit failure destroys employment. Argentina experienced repeated cycles of bank freezes and capital controls. The pattern is always the same. Financial failure first feels abstract. Then it becomes personal. Failed fixes. What makes IT worse? Governments often choose the wrong solutions. They freeze prices, impose capital controls, blame speculation. These measures calm panic temporarily, but they break trust permanently. Once people believe rules can change overnight, they never fully trust the system again. The real danger: systemic cascades. Modern finance is interconnected. One failure triggers others. A bank failure affects insurers. Insurers affect pensions. Pensions affect households. This is called systemic risk. And it moves faster than policy. Modern parallel. Why today is more dangerous. Today's system is larger, faster, and more leveraged than ever. Trillions move in milliseconds. Debt levels exceed historical norms. Derivatives link everything. This increases efficiency and fragility. Small shocks now create massive reactions. What survives and what doesn't? In financial collapse, physical goods matter, skills matter, community matters. Abstract wealth disappears first. Real value remains. History shows this again and again. The aftermath, what comes next? After collapse, systems rebuild. New currencies emerge. New rules are written. New power structures form. The old order never returns unchanged. Financial failure is not the end. It is a reset. 3 takeaways, the hard truths. Takeaway 1. Financial systems fail from loss of trust, not lack of money. Takeaway 2. Liquidity solves panic temporarily, not structural weakness. Takeaway 3. The deeper the leverage, the faster the collapse. Final warning, the question no one asks. The global financial system has survived crises before. But each rescue makes it larger, more complex, more dependent on confidence. So here's the question history forces us to ask. What happens when confidence itself can no longer be restored? If this changed how you think about money, stability, or risk, subscribe. Because financial collapse doesn't announce itself. It arrives quietly, and by the time everyone notices, the system has already stopped working,